Welcome to the Inside Silverstone podcast, a business-focused podcast covering all things tech, engineering and innovation. Hosted by me, Chris Broome, a huge tech, motorsport and gaming fan, and also the owner of Longhurst, a firm of lifestyle financial planners and independent financial advisors located in Silverstone, Northamptonshire. This is a series of unscripted and unpolished conversations with leading business owners, thought leaders and high-tech talent where we discuss their experiences within the Silverstone business and motorsport region. We will also be asking them to share their knowledge, insight and their thoughts on the future just for you. If you're looking to learn more about the Silverstone high growth region and commercially connect with like-minded peers, you've definitely come to the right place. Welcome to Inside Silverstone. Welcome to the next edition of Inside Silverstone. My name is Chris Broome and I am your host. Right, today we're doing a first for Inside Silverstone and also for the Silverstone Technology Cluster. We are hosting a Mastermind Session, which is where, and the idea of which is to get together professional advisors who are connected to the Silverstone Technology Cluster, where we would do a roundtable recording, which I've also decided and sprung it on you all to actually do a recording also.
Thanks, Chris.
Why you're all looking a bit awkward, where we would be talking about a specific subject, a challenge perhaps that a business owner or a business may be facing, where collaboratively we will sort of do a roundtable discussion and a bit of a chinwag about ideas, strategies, what things specifically mean. And so today's mastermind session, which is number 1, is called Capital Raising for Dummies. So I've invited 4 wonderful guests on the show who are going to quickly introduce themselves by name and by the business and also what they specialise in. So I think we're going to start here. So okay. What's your name? What do you do?
Hi everyone. So Ryan Shields. I work for Grant Thornton. So the audit tax advisory firm. I sit in our corporate finance advisory team. So I help shareholders, business owners with creating value in their business, realising that value as well, whether that's through selling their businesses, looking at their strategic plans, acquiring other businesses, raising capital falls into that. Mm-hmm. And then we work on a whole host of other kind of strategic matters with shareholders. Great,
Ryan, thank you, and thank you for coming on the show. Chap, who are you?
I'm Matt, I'm from Barclays. I'm a high growth and entrepreneur relationship manager. So I look after companies that are scaling up and undergoing that journey. We look at companies that are raising capital or have raised capital beforehand. So hopefully we can add some specialism around that. And I cover Bedfordshire, Buckinghamshire and Northamptonshire.
Matthew, thank you. Who are you?
Hello, I'm Kirsty Simmonds. I'm a lawyer. I work for a firm called EMW. I head up our startup and scale-up team. I love working with entrepreneurs and early stage businesses and helping them grow, helping them take on capital to realise their growth goals. And we can help with everything from the start of the process through to getting them ready to raise capital, right through to the funds hitting their bank account.
Wonderful. Thank you, Kirsty. And last but not least.
Hi, I'm Tom Haywood. I'm an investment manager at Froesight Group. We manage about £3 billion of money. £500 million of that is in private equity. We do predominantly what's of interest, I think, to SDC and our clients in this region are growth equity investments in early stage businesses looking for investments of 250k up to 1.5–2 million.
Tom, thank you. And for those that don't know me, I'm Chris Broome. I'm a chartered financial planner at a business called Longhurst, which I also own. We have a natural but not exclusive niche advising firms that are involved in the sort of technology and engineering space. And we're also a member firm of the STC. Right, let's move on to the questions. So, we're talking about capital raising for dummies. And so we've all listed some questions that we thought might be useful to sort of talk through. But actually, one question that's actually not on here is why capital raise in the first place, which is a bit of a generic question. So I'm sort of just going to throw that out there. I'm not going to pick on any of you. So somebody sort of raise their hand and start. So why would a business need or want to capital raise?
I'll start off on that basis. A lot of people have entrepreneurs in particular have a great and phenomenal idea, but actually to conceptualise that idea is they're going to need significant sums, I would say, to bring it to an MVP stage.
And what's an MVP stage?
So minimum viable product stage. So you see a lot of entrepreneurs use the capital funding for that part because they realise that they're onto something. It could be a disruptive technology, but actually they realise that they can't just do it by themselves. So actually they turn to capital raising to enable them to realise that opportunity.
Okay. Any other reasons? That was a pretty comprehensive answer, but any other sort of comments to that?
Yeah, well, I think I'd add that where in particular you'd want to capital raise is if you want to accelerate your growth plans. So maybe you're kind of petering along at a pace that's nice, a sort of lifestyle business, as we spoke in another podcast. And you want to accelerate that growth and go for the stars, and you need some investment to either hire more technical people, more biz dev people, or whatever it is to help you with that, which you can't do at the pace you're currently going at.
Okay. What avenues are available to fundraise? So this is actually a question that you, Matt, again. So Matt from Barclays, you're the one that sort of posed this question to us as a collective. So we'll start with you. So what avenues are available to fundraise, and what if I was a business owner, what have I got to be careful of for each of those?
Well, I think we're opening up to the group of the what to be careful of, but I think depends on the stage of the business as well as what typically people turn to. I think in the early stage, it's seed funding, it's friends and family raising, or even crowdfunding. Mm-hmm. So if we pick on one of those, anyone want to pick on a particular one which we can explore in a bit more detail?
I'm really interested in the crowdfunding scene.
Okay.
To be honest with you, and actually see, that's fairly new to the environment in the last couple of years, and where that's going to play out in longer term, I guess. GT's agenda when they finally come to realise value in kind of sales, but where crowdfunding sits within that, and then where it's been used well and where it's been used badly, because I think some of the crowdfunding, kind of platforms have differing kind of reputations and reviews, whether it's a volume game that they put through it or whether it's a quality game.
So let's start just by explaining what crowdfunding is. So for anyone listening to this, including business owners, but even maybe students who might be picking up on this, what is crowdfunding?
Crowdfunding, I guess, in my opinion, is where using kind of one of the platform businesses, a business owner or an entrepreneur puts their idea up, puts an element of their equity up against it, normally a set element, and they normally have a kind of minimum cap that they want to give away, and it's effectively making that early stage investment accessible to all. So whereas previously it may have been venture capital funds, angel investors, private equity, it's now making it, you and I can invest in those kind of ideas.
So this would be open to just a general investor who might just like a certain topic or niche, or see an advert for something, or be on this platform and think, actually, that sounds really interesting. And then basically on there would presumably be some sort of prospectus from that business that's saying that this is what we're offering. And
typically followed by a video, showcasing what their product is, what it does, what it actually solves. And depending on what channel they use, sometimes they give not just the equity, but also a discount on the product, as well as an incentive to invest through that channel.
Okay.
Brewdog, is a classic example of that, isn't it? They're a really successful company. They initially crowdfunded, and they gave lots of discounts on beer and products throughout their range.
Yeah, presumably we've all had a brew dog here. I certainly have. Yeah. Okay, and presumably there are risks though with crowdfunding. Are there risks with crowdfunding as the business owner?
The risks that we see from a business owner, the risks from an investor point of view is you are reliant on that prospectus that is
total loss. Presumably, you've got total loss on that.
Yeah, you've got total loss on the investment, and you are very reliant on either the platform or it's diligence light approach.
Okay.
You can't go into much more than they are willing to give you on information.
Company's house, I guess, looking at stuff like that. Yeah.
I think there are a couple of problems we see from Froesight point of view, particularly as these companies look for late stage funding. The first thing is that the people investing, although it's commoditizing, bring it, investing to the masses, they tend to have no idea about valuation. I know we'll come on to this a bit later on how you actually value a company. But they think, that's a cool idea, Brewdog, nice beers, great thing, and they don't look at the price they're paying.
Right.
And fundamentally, the return you get is based on what your entry price is. So if you look at private equity returns across, multiple decades, even now, a large chunk of your exit is determined by the price you enter in at. So firstly, our experience is that people tend to overpay. And then what the second result of that means that if a company does want to raise a further growth round as a result, often their valuation ambitions are too high for professional investors.
Downsize it, don't they?
Which means you'd have to either do a down round, which is really damaging for the company and existing investors.
What's a down round for the people that don't know that?
Down round is, let's say, an investor invests in crowd funding platform at 10 million pre-money valuation, and then it invested 1 million, so the post-money valuation is 11 million.
Yep.
And then another investor comes and says it's not worth 11 million, we think it's worth 5. So then you invest at 5, so the value of the company that was 11 million is now worth 5, effectively. And that causes all sorts of problems with management, and as well as obviously the shareholders get frustrated. But often it actually means that investors, VCs, won't even look at those companies that have crowdfunded, because you just think these valuations are 3 times where I'd expect it to be, so we're just not going to bother spending any time on it.
Another problem from a business owner's perspective is you've got no control over who the people are, who the crowd is they're signing up.
Right.
So you can't do any due diligence on them.
Okay.
So it could just be anybody. They don't have to have previous experience. You could just then be opening yourself up to having numerous shareholders, and that could potentially cause you difficulties moving forward.
Okay, so that's crowdfunding. What other avenues?
I said friends and family, which is, friends and family which you turn to anyone that you know, raise a little bit of money by them putting in and giving a bit of equity away. I'd say the pros with that is that you know who they are, so technically you'd rule out that due diligence, but also the cons on that is that you know who they are, in the fact that could damage your personal relationship with them if the business doesn't quite take off as expected.
How important to external investors is it to see that a business owner has actually gone and got friends and family investment in it, and also that they themselves have put some skin in the game before they've gone out to seek other forms of investment? Is that important? It's just even just psychologically, I think actually that you've done that, you've been prepared, you're that confident on your solution or your product that you've sort of done that.
It's the feedback we often get when we speak to investors, private equity houses, and even at the earlier stage at angel investors. They want to understand, if an angel investor, you're going to ask for their money. Have you put your money forward? Have you, you're not sitting in £1 million house that is mortgage free, and you're fine on that kind of, and you're coming and taking their money and putting their money at risk. They want to see that you do have skin in the game, and you also have gone to the initial people you go to is normally friends and family. If you're that confident in your idea, and it's a balance that you don't want to stress those relationships.
Sure.
But there's a balance of probably seeing that. That they're going to back someone that fully believes in themselves. Yeah,
bank of mum and dad, right? So good old mum or dad supporting you with some of their savings, I guess, and then making sure you pay them back. Don't want to upset your mum, right?
It does, as you say, what Ryan says, it overcomes that commitment question mark. How committed are you to the business? If you've got your own money in the business, I'd say you're going to be a lot more committed than if it's someone else's money that you've used.
Okay. Hi, Chris Broome, creator of the Mastermind Session. Breaking news. I promise this is not one of those annoying LinkedIn videos. I promise. Basically, big apologies. There's going to be a slight dip in the audio for the next session of the recording. Look, I'm a financial expert. I'm a meticulous one at that, and very, very passionate about helping my clients when it comes to creating content marketing. I'm relatively new to it, and unfortunately when we were recording we had a slight camera malfunction, which meant when we then started re-recording there was an audio issue, which we didn't realise until after the recording. So this video here, this little interlude, is me just apologising to you to say, look, audio quality in the second half is going to be okay. Hopefully the subtitles at the bottom are going to help, and I promise that future episodes that we record I'll do much, much better. Thank you very much for your time, and hope you enjoy the rest of the show. Right, and we're back. Literally, this is a live recording, as it were. My freaking camera ran out of memory, so that's why you've just experienced a cut. But we can all laugh about it, and we're going to share this moment together. So, Matt, you very kindly were talking about, obviously, what you're talking about, and it literally went across to Tom, literally, as it cut off. So, Tom, why don't you continue where we were regarding...
Yeah, so it's around the friends and family raise we're talking about, and commitment shown by the entrepreneur. So I think that effectively, if you don't have wealthy friends or family who can help out, I think that commitment can be shown in other ways. So, for example, if you're working during the day and you're working on it at night, and just really kind of swashbuckling around to kind of get your business off the ground. So it doesn't necessarily have to be
a monetary part.
Exactly. Yeah. You might people have started companies off really small amounts of cash, 100 quid, and also, and particularly with how cheap cloud services are, working on your tech business, it's cheaper than ever before to really get it off the ground.
Okay. Any other sort of sources of and avenues of fundraising apart from that? So we've done sort of crowdfunding, we've done obviously friends and family. What about obviously what you sort of specialise in, Tom?
Yeah, venture capital. Venture capital is, more of a particular form of capital whereby you really want to scale and grow up the business as well as benefit from the extra kind of governance that venture capital brings with it. So the idea is that if you want to build, scale, grow a company to exit, then venture capital is your best port of call. If you don't want to sell your business or exit, then I wouldn't get involved with venture capital in the first place, because that is the reason why venture capital exists. So the amount that what's good about venture capital versus angels or crowdfunding is that you're just dealing with one house, one investor. You don't have multiple stakeholders and shareholders involved, and you also benefit from their experience in building, growing, and exiting companies.
Risks with venture capital?
With taking on VC money?
Yeah.
The risk with venture capital money is around the governance on the other side. That I think if the company isn't performing or the valuation, you're not performing to the valuation that was agreed at before, then you face risks such as strategically the business model will have to change, or there have to be change of management, or all sorts of things. So basically, the money doesn't come for free,
sure.
And there are expectations from the investors as to what the outcome of the business would be. And I think it's if you do have a higher appetite for risk and really want to build kind of a £100 million plus company. VC is the way to go, but there are definitely downsides.
Well, they typically try to support that, don't they? Because a lot of VCs ask for an option of a board seat, don't they, to help that journey. And like you say, caveat of that is if it's not performing, obviously that's when you can really action on that as well. So they do try to obviously support that because it's in their interest for it to work out. They want it to be a good relationship.
Yeah, so everyone is aligned in terms of what they want at the end, or they should be, that you want a good exit for everyone. But invariably you'll end up with potential conflicts at times that you have to navigate through.
Okay.
But clearly if you've got a chair on the board as well who's done this for 30, 40 years and you're a young 20-something entrepreneur, I would argue that you benefit more from having that experienced person on the side of you than some friends and family or whatever.
Yeah. The good thing is we've recorded a podcast specifically regarding obviously what you guys do, and so that will be aired probably after this recording. So that'll be for those listeners interested in that a bit more. What about banks? So Barclays Bank. So how can they sort of help businesses raise money?
So we obviously predominantly are a debt-backed company, and what that means is that we won't come in an equity as an equity stakeholder. Would come in and back them through various debt options, which again, when a company's raising capital, they've got to look at what fits best for them. So equity, obviously you're giving up part of your business. Debt, you're probably not, but you are.
Oh, you're not giving it up, you're selling part of your business.
Well, yeah.
That's how investors like to look at it.
Yeah, well, yeah, absolutely. Correct wording there. And with debt, really, what you're looking at doing is, what covenants have you got to offer a traditional lender? Because a traditional lender predominantly would be a secured lender, which means you might need to give up personal guarantees or mortgage on your property, etc., etc. So there's different avenues that they look at. Caveat to that, however, though, we do have a venture debt proposition which comes in alongside the venture capital raises. So we like to support companies and give them an additional amount, so they're not going to be giving up more equity, which is, I think, quite unique actually in the market.
Okay.
I guess it's a question for the business as to whether the debt, when they go down the debt financing route, you have to pay that back, not usually with interest. In the equity route, you don't pay it back as such, but you make a return on the investment for the investors. So it's working out which financial model works best for you and your business.
It's understanding the business plan and where you need to go there, because I think there's a time horizon piece in whatever option you take with partnering with a VC. There's often a clear time horizon on where their return and how they need to make their return. With a debt kind of angle, you have your often your capital repayments, whether that's phased throughout or a bullet at the end. But with that kind of debt angle, you've got the cost, you've got your interest costs.
Yeah.
You can roll things then, but potentially you're not going to get the expertise that you get with a VC and the ability to, if you're in a really fast growing industry, potentially you need that expertise, you need that ability to sell that equity stake, but then to get follow-on funding, which is often available. It's kind of working out what's right for you.
Totally agree.
And with what timing.
I was going to say what age the company is depends on what solution would meet you. So the venture debt piece that I mentioned, that's typically supporting a Series A round. Whereas there is a lot of solutions that we offer which are from startup up to years within the business journey of the company, and each have their own sort of solution for the client to really help them grow. So what I would suggest is if you are a company, you speak to the people that would be involved. You speak to your bank, you speak to people on your board as well about what the growth journey looks like. And then you look at all the options.
It's always an interesting one, asking whoever the investment, where, especially when you're selling an equity stake, asking whoever is taking out funding if they've got previous examples where that's gone well and where that hasn't gone well. And understanding what kind of investor they are. Are they someone that at the slightest kind of issue will come in and will kind of an autocratic kind of this is how we're doing things and this is how we're going to manage it going forwards, will remove people from their roles, or whether actually they'll come in there it's kind of solution led kind of that's what they're focused on, because most investors, to be honest with you, don't want to get rid of management teams. They don't want to run businesses. They help businesses, and they will assist where they can, but it's really they're backing the people in that business to really grow it, and that's what they need. It's the people on the expertise. They're the ones that have developed it.
You have to understand what time frame they're working on. So if you do a seed raise, they might want an exit at $500 million. They could look at that. So you need to know what they really are looking for, because that's as Todd mentioned, is the alignment. And really, you want to partner with someone who's aligned with the same as yourself, because you'd rarely find a VC company that'll be happy for you to exit earlier because actually they backed you. So they're expecting that you're in there for the same time frame that they're in there. In most cases.
So I've heard the phrase investment ready. So what does that mean? Start yourself, Kirsty.
Sure. So it means putting your company in the best possible position so that when you're having conversations with your bank or with an investor, that they say, yes, I will lend you this money, or yes, I will invest in your business.
How do you do that?
Well. So top tip would just be to go into the process being prepared. So prepare to plan. So raising capital, it's important to plan for that. Plan not only for what you want, but what you're going to do if it all goes wrong, if you can't get enough money. And as Ryan touched on earlier, do some due diligence, particularly on your investors. Find out what their experience is. If possible, try and speak with companies that they've invested in. What's their approach been? Just really try and understand their approach so that you can ensure that you're aligned and that your futures are working towards the same path.
Okay. Anyone got anything to add to that?
Yeah, I think I'll just tag on. I agree with everything I say. I would probably add on from our perspective that a lot of focus on business plan and slide deck.
Yeah.
Our initial point of call as an investor, or the first email I always reply to, is please can you send me your deck, which should just be a 10-page or so slide deck, or even an investment memorandum, like a 2 or 3 page Word document. Just outlining your business plan, why you need the money, what the money is going to be spent on, and then at least that informs the basis of discussion as to whether it's something that an investment wants to take further or not.
Okay. Any top tips on what not to do? Is there any? We're talking about what to do, but anything that investors or professional advisors
I was going to say, not if you haven't done your research, you're instantly on the back foot. So you really need to understand your industry, understand the potential of where the business can go, and also what target market are you after. Because if you don't understand those three things, really you're not investment ready.
Right.
Because you don't know the scope of what your business can go, and it should be covered in your business plan, it should be covered in your investment deck.
You got to make sure the market's ready for
Absolutely.
whatever you're offering. The
Yeah.
product might be way too much. You've got to, sometimes it's educating the market about what you need, and you're the next step and why they need to buy your product. You may actually be too advanced, and you may see,
General
the
Magic,
product.
right? General Magic is a prime example. I know you've obviously got to watch that video as part of the STC event, but phenomenal. Created the phone, what we've got here back in the 80s.
Yeah.
Far too ahead of their time, as it were. So absolutely perfect example.
I think we always, when you're getting your business plan ready, and we always treat it like, and probably a sports analogy of like you're still in the changing room of, you can sort. That's where no one knows what's going. You're not out on the pitch yet. You've not started. You can clear up all the stuff, any skeletons in the closet, any financial, tax, legal issues, employment contracts.
Yeah.
Sort all of that before you get out to showing your memorandum out to the market, because that's the first thing that will scare off the kind of investor if you're dealing with those kind of issues. And then the other piece is whatever time horizon you've got for raising money and making sure, have a think about, your forecasting for that. The last place you want to be is, you've got a 6 month time horizon that I need to raise money by then because I'm out of money by then. You need to have enough kind of headroom. You can keep going, that you don't get into, you keep your power effectively, then you don't get into a desperate situation of someone puts an offer on the table and you have to take it because you can't pay wages in a couple of weeks.
Okay.
And also, sorry, just to touch on what Ryan said, just be prepared for the due diligence process that you'll undergo. So the questions that the investors will ask you about your business, just be prepared for that and make sure that you're ready so that, like you say, if you've got all your key employment people on contracts, they're not going to up and leave your business and already
Your IP's protected
die away.
as well.
IP, absolutely. Make sure you've got a strategy to protect that IP that you have now and any future development. Just have the foundations and the building blocks ready before you then go out to the market. It's much easier to get your house in order beforehand rather than in trying to run a funding process at the same time.
I'd also say as well that you probably need to take a step back and have a word with your professional advisor around things like NDAs and stuff like that's going to be involved during that process, because you are going to release a lot more information about your company, and if you've not prepared that right, what's to stop them telling anyone else about what you're doing? So you need to understand their intentions and also make sure that you're correctly legally backed up.
So NDAs will be done through the lawyer, presumably?
Yeah, it's a really common question we get asked actually. When do you ask an investor for an NDA? And generally sort of the advice would be that the more experienced the investor, the less likely you should be asking for an NDA, because investors will come across lots of opportunities and they don't want to be limited to talking to other people about various opportunities that they might face. But if you don't know the investor, and it's particularly if it's an individual, definitely get an NDA in place.
Okay.
Yeah, it's working out the release of information about what you need to do, because I think some of the sales memorandums that we prepare all have NDAs before we go out to potential buyers or potential investors, just to the kind of the size and scale of opportunities that we look at. But at the earlier stages, working out. But I still think some of the sales memorandum, I don't think it's hugely sensitive information. There may be customer names in there, but for some stuff, if you've got someone selling into a supermarket, you can go to 4 different supermarkets and work out how they're selling all these supermarkets. And they're their big customers. It's working out what are you giving that's really sensitive. If that's a crux of your business idea, and kind of how can you present it to start getting them interested, start getting them, kind of bringing them along the journey, and at the right time. It's not day one you release this is all the IP we've got protected. This is the basis of our business. Get them interested in other ways, but there are going to have to be some situations where that's the first thing you have to share with them, because that's the first question that you will get from them. But make sure you're adequately protected.
Yeah, it's really important to get advice around all of this, because business owners are amazing at what they do, their product or their service, but actually fundraising is a really can be a really difficult thing to do. So just take some advice about how best to deal with it. Let people who do this, day in, day out, help you with that process.
And where would that? There's a list of other questions that we're going to move on to, but where would they start with that? So let's pretend. Presume they'd obviously have an accountant. I guess they may have a banking relationship. They may even know some solicitors. So who would they go to first? Does it really matter?
Any of the above.
Yeah, any of them.
And actually, what you want is all your advisors to be joined up. So actually, to have a three-way conversation between your banker, your accountant, your lawyer.
Yeah.
Make sure everybody's all on the same page.
Okay.
That really helps.
Like a trusted team.
Yeah, absolutely.
Whichever advisor you're using, and whichever advisor, because we find, we're primarily accountants.
Sure.
We probably do see less of the earlier stage stuff. I think you probably use, you set up your bank account, you start getting your, various kind of articles drawn up initially. You need bankers and lawyers initially, but it's whoever you go to, they will point you in the right direction for what they think you need, and what level of kind of advice you need to take.
Sure.
You don't need to take a Grant Thornton or a Big Four accountancy advice, when actually if you're a much earlier stage business, a much local accountant would be much more suitable.
Sure.
And that will be the same for bankers, lawyers, etc.
Yeah. Valuations. So I'm a business on a capital raise. How do I value my business? Who wants to start with that?
Shall I start with it? Because I posed the question. So pretty much my de facto kind of piece I go to is it's an art, not science. And everyone will have a different opinion on it. And we often, I could go into a meeting with Tom on the kind of VC, I will present an opinion to him there. It may not be the opinion that I take elsewhere, and sometimes I have an opinion for a reason for the valuation. There's a great number of ways that you can look at it, based on kind of multiples, whether that's profitability multiples, whether actually in earlier stage tech businesses often look at revenue multiples, whether it's kind of an asset-based valuation of, you often do that with businesses that are heavily asset-backed, so car dealerships, you'd have an asset-based valuation with
stock,
maybe some goodwill on it.
Yeah, how do you value goodwill?
Yeah,
there we are. I'm going to put you on the spot.
How do you value goodwill? So normally you have in the kind of car dealership model, you have you pay your net assets potentially, plus you'd have an uplift for it's a smaller multiple effectively of your profitability. To be honest with you, when you get to valuation, it's working out what the market is telling you. The market will tell you the value of your company. Yeah, you can have a number in your mind. If 3 or 4 different sources come back and say you've got 10 million in your head, but they're coming back and they're all offering between 6 and 7 million, unfortunately that's probably the value of your business.
That's the number, right? That's how capitalism works around the great markets. That's exactly it.
And you can decide on the timing of when you need to do that, whether you want to go now, whether you want to grow it to 10 million. But goodwill is, people try to underpin things with methods and valuations and point towards those, and we often do it. When we're valuing businesses, we'll give you a range of measurements to get a range, but what it comes down to is what someone is comfortable to pay and what you are comfortable to accept.
Sure.
I would maybe add a few things onto that. What we've seen between good advisors and less good advisors, let's say, is that fundamentally from a VC point of view, all we're looking at is what possible return we can get, and there's a particular VC valuation model you can kind of apply to that based on what you think the company will sell for, and applying percentage probabilities to it. And that's what everything is based on. All multiples are based on fundamentally that. So we would always look at sales multiples, as you mentioned, and then EBITDA multiples, if applicable. If it's pre-revenue, then you're looking at comparables in the market, where the market is moving. And clearly, we're in quite a toppy market right now. There's a lot of capital chasing a few companies, and that's driving up valuations.
Which is fantastic for us.
Which is bad for the VC funds. But what is bad is when people come in, and I've had this before in some meetings, say, I've drawn up a DCF model, and I used to be in investment banking, and I did that for my first startup, and I was on the side of the fence. You just don't do that. It just looks awful. Again, asset models as well for sort of tech growth companies, you just never look at. Another one we've recently seen is valuing IP portfolios as well, which I have no idea where that came from, but again, it's completely meaningless. And And so when if an advisor comes who've got this business like, we've looked at it on a DCF basis or IP portfolio and we think it's worth, 50 million, but we'll probably discount it about 15. You think, this is mad. This is not how VCs operate. It's all about the exit and then backing out from that. It's got nothing to do with anything else.
I think that's right. The only time we would use a DCF kind of discounted cash flow valuation is we would use it in a range of comparisons. It will always be the top valuation, and it will be, by far kind of double sometimes, what the other valuations are saying. So you never turn around and you point to that. That's got to be the valuation because someone will not pay that.
Yeah.
So, and
particularly when you're at an early stage, just don't get too hung up on what the valuation is, because 100% of nothing is still nothing. Take some advice and make sure that you've thought about it and that you've got some guidance around.
And how do you, I'm a business owner, I want to capitalise. How do I calculate how much of my sort of equity stake I'm prepared to sell, for that investment? Is there a mythology to that? Is that just how I feel? Is it emotional?
It's a little bit too, you've got to be in the realms of your own comfortability first. I think before you do anything else, you've got to know what you're going to be comfortable to give up of your company. That's the first thing that I'd overcome if I was an owner is how much of my baby am I really, really prepared to let someone else have?
Yeah.
And then really it's about, looking at the professional advice around, what does it actually look like? How much is that worth? What should I really be asking for that amount that I'm prepared to give up?
Are there any percentage numbers?
There's a couple of binary kind of numbers that kind of control.
That's my next question. So for those listening who aren't aware, what are those tipping points where control is potentially?
So we have your 50% kind of piece. You also have at 25%. That's where you can pass certain resolutions. You need over 75% control. So you need to think about there's certain pieces there that, in your head, the valuation may change between 24 and 26% more than just the mathematics. You also need to think about it and actually speak to your tax advisors. And sometimes because the amount you take out, is it going to be eligible for kind of the capital gains kind of regime, entrepreneurs relief? Take advice on that because that can have a big, getting stuff out, getting money out at 10% tax versus paying 20% can have quite a big impact on you or, what you want to do with the money.
So just a quick snapshot there very quickly. Entrepreneurs relief, so just explain that to those listening.
So entrepreneurs relief, it's a government scheme effectively. It's underneath the capital gains tax scheme. I probably have to admit I'm not a tax advisor, so none of this can be.
Sure, but it's a generic statement.
But it's where you have a lifetime limit of £10 million where you can take, you can realise the value in your share sales at 10% tax.
Okay.
Versus the normal capital gains tax is 20%. Both are fairly, even the 20% tax is a fairly nice rate of tax. Compared to if you take it out of dividend rates,
income tax
you're high 30, 40% that you have to be paying. So it's quite a big advantage the government are offering. Where it is at 20% at the moment is probably, historically, it's quite a low rate.
Yeah.
So it's a fairly friendly tax environment.
Okay, great, thank you. Timescales. So I want to capitalise. There's obviously a number of paths that we've explored to get that, but how would I manage my expectations?
It always takes longer than you think.
Definitely.
Yeah.
I think what we recommend if you're seeking ventures was about 6 months from start to finish. And that's what we recommend for portfolio companies doing follow-on rounds as well.
Just don't underestimate the legwork in terms of going out, finding investors, having those initial conversations, drumming up interest. I'd say 6 months. Plan for that because, as someone mentioned earlier, you don't want to be in a position where you're accepting any deal. You want to make sure it's the right deal. So plan.
Yeah, and that would broadly split out of 3 months of conversations, meeting investors and so forth, and then 3 months of execution with a little bit of sort of latitude of a month or so in the middle.
Okay, and if someone went to a bank and they were looking to sort of debt raise?
It depends on the vehicle that they're looking at. I think if you're looking at raising it through a commercial mortgage, for example, give yourself a 3 month leeway because there's a lot involved in valuations of the premises. guarantees if they need to be there as well. So there is a lot of legal work that we have to do. Well, not ourselves, but our friends from legal firms have to do and are involved in. So again, it's really about making sure it's the right vehicle for you to use. And what does that mean? Don't underestimate that there is a lot of work, and it needs you to be able to be involved in that process as well.
Yeah. So
if you're hands-on, really involved in your business, but you need to do this stuff, you need to set some time aside to enable you to be involved in that process. So you need to obviously think about that at that time. But yeah, it depends on what is the right viable solution. So if it's a smaller amount that you're looking at, that can be turned over relatively quickly. But if it's a large amount, you're going to be looking at some different documentation that would have to go through, which does take time.
Okay.
People do use it as kind of in the funding scene, the equity and that kind of funding scene. People use it as a differentiator now, and you see a lot more people coming to the market with, we can get you money in 2 weeks, a month, and making these promises, and it's just making sure that's the right, that often comes with a price.
Sure.
So is it?
I was going
to say, I always look at that good, cheap and fast scenario.
Yeah.
You're only ever going to get 2 out of those 3 that are really viable.
Yeah.
So again, if it is something that's available really, really quickly, what are you actually giving up to enable that to happen?
Yeah,
it might be that you're giving up a lot more than you anticipated for.
Okay, next question. EIS. SEIS. So, for those that aren't aware, listening to this and potentially watching it, what's an EIS? Who wants to start?
I'll take this on.
No one being tax advisors.
To clarify, not tax advisor, just a lawyer. So SEIS is a seed enterprise investment scheme, and EIS is an enterprise investment scheme, and it's a HMRC approved tax efficient way of allowing high net worths to invest into your business.
Okay.
So they make an investment, and depending on the scheme, so under SEIS, it's up to 50% of the income that they invest, they can then deduct from their income tax liability.
Okay.
So it's really attractive.
So I'm a business owner, I'm looking to raise capital. How does that help me? So are there sort of funds out there that basically can invest into my business? Is that how it works?
I was going to say, how many times does that come up as well as a question? I think investors will ask, are you, is that an option we can turn to? And if it's not, actually that might be a handicap. So then you have to build in getting registered for that, which is 6 to 8 weeks now.
Yeah,
that's a good point. Advance assurance.
Yeah,
you make an application to the revenue, and they take as long as they take really to respond and to confirm that you comply with all the criteria. But 6 to 8 weeks is probably about reasonable to get a response.
You put yourself in the investor's shoes of what they want. It's their downside risk protection of how much money they can offer you.
Mm-hmm.
Is if 50% of that can be, income tax relief that they can get, and it's, they can price it in. So it is important to have it. And I think more of the kind of crowdfunding platforms, you get that kind of advance assurance stamp alongside some of those investments of kind of SEIS, relevant EIS kind of, because that is quite an important thing for people when they're looking at, whether they're looking at you through angel investment or crowdfunding kind of piece where they'll put their money.
Mm-hmm.
So just to put it into some sort of context for a business owner, if you apply under SEIS, the risk to the investor for every sort of 10 grand of investment, they're actually only really risking about 2 grand.
Mm-hmm.
So that's really attractive for them. So it should matter to you as a business owner, and you should try and get that advance assurance to
and how do they do that? And who would they go and speak to get that sort of set up? What's the process?
An accountant.
An accountant,
To help with that.
Tax advisor.
Tax advisor.
Will help you, So.
Yeah.
Okay.
It's not BGT offer.
That's
That's
why I was looking at you when I asked the question. Okay, fine.
I just don't happen to be a tax advisor.
Sure. Any more sort of comments on sort of that as a subject matter?
Obviously, so Froesight operates an EIS fund, the Williams EIS fund, which I predominantly work on, and there are various funds out there if you're not just speaking to individual angels. SEIS funds are rarer, simply because you can only take 150k in capital per company. I think it was per year. or total. Well, either way, the limit's much less, whereas EIS, you can take maximum over its lifetime about £20 million. You therefore funds can really operate in that space. So you said tend to see more funds on the EIS side. On the SEIS fund, it's much, much rarer, but individual angels can invest under that.
Okay. So we've covered off avenues for fundraising. Capital raising.
Interchangeable.
Do you know, I said that to Sally Povaletsky and she told me off for saying fundraising when I interviewed her for the podcast, so I'll stick to capital raising. I'm going to get on Sally's wrong side. We've spoken about how to get investment ready, what it actually means, and how companies can put themselves in the best position to become attractive for investment. Valuations, funds raised versus equity, timeline, EIS, tax reliefs. Before we close off, is there anything else that I haven't really covered off? Anything else that we want to sort of talk about that's burning right now?
I just think my sort of key bit of advice, we don't do it alone.
Okay.
This is sort of an art form in itself, capital raising. So
this is the trusted team point. So this is
absolutely.
Go and speak to your trusted accountant if you've got one, potentially a bank, and seek their opinion. And if not, potentially go and speak to other business peers that you've got to see both potentially what they've done and who they potentially work alongside.
Yeah, I think actually that's a good point. Speaking to someone that's been through the process before can be really helpful.
Yeah.
Because then, particularly as a business owner, then you'll get real insight into what difficulties they faced, the challenges that they overcame from someone in your shoes looking to go through.
Yeah, shared knowledge, right, is the best kind. So go and listen to people that have done it.
From the investor side, I would agree with that. Companies that we see that have been advised generally tend to have much better presented decks and they know all the information the investor is looking for. And also as a result, you can probably achieve better valuations than you would if you weren't advised, which will more than offset the fees you paid the advice in the first place.
Yeah, to raise money, you're going to have to pay out a bit of money to start.
Yeah, you've got to see that as an investment, right? I think that's with any professional service that you receive. You've just got to see it as an investment in yourself or in your business.
That initial conversation doesn't cost a thing. Having a conversation with them, if it's not right for any of the firms or any of the things, we will connect you to people. It helps us, it builds our network. That's what we're coming in for. So we will point you in the right direction for who is best placed. Or who are the kind of investors, even if it doesn't fit from a fee point that, say, GT can earn from it, we'll tell you, maybe you should have a think about going and speak to these three, Froesight have got an EIS fund, it may be a worthwhile conversation to have.
Yeah.
You can have a conversation with a few people, get some free advice.
And
then, absolutely.
Right. I think that's it. I'm going to draw this podcast, the Mastermind session, to a close. So just to go around the table again. So we've got Ryan Shields from Grant Thornton, thank you. Matthew Lawley from Barclays, thank you. Kirsty Simmonds from ENW, thank you. Tom Haywood, Froesight, thank you very, very much. Everybody, thank you. The Inside Silverstone podcast is produced by the team at Longhurst for the benefit of those with a passion for all things tech, engineering and innovation. For more information, please visit longhurst.co.uk/Inside Silverstone, whilst also remembering to give us a 5 out of 5 star rating on iTunes. Please note that neither Chris Broome or Longhurst work for Silverstone Park, Silverstone Circuit or Silverstone Technology Cluster.